There's a quiet lie sitting at the center of modern retirement advice. It doesn't scream. It doesn't look dangerous. In fact, it often comes dressed as guidance, responsible, even helpful. The lie is that if your savings number doesn't look big enough, then your retirement must be in trouble. And that lie gets even more dangerous when tax rules shift quietly in the background, and most people never hear about it. Now listen, the IRS does not usually announce changes in a way that lands in your living room and grabs your shoulders. It creeps in through thresholds, deductions, timing rules, and contribution limits. Quiet updates, a few $100s here, a few thousand there. But for retirees or people close to retirement, those small changes can quietly change what stays in your pocket and what slips away. And in 2026, there are 4 rule changes that matter a lot more than most people realize. Not because they are flashy, not because they make headlines, but because they nudge your tax bill, your withdrawal plan, your cash flow, and even the way you think about when to claim income. Let that sink in. A retirement plan can look fine on paper and still fail in real life if the income side is weak. Think of it this way. Your income floor is like the foundation of your house. Strong, underground, invisible, but holding everything up. Your savings? That's more like the furniture. Nice to have. Important, yes. But the furniture is not what keeps the roof from falling in. The real question isn't how big your account looks. It's how strong your income floor feels when the bills show up every month. That shift matters because retirement fear is rarely loud at first. It shows up quietly, in the grocery aisle, in the pharmacy, in the property tax bill, in that strange little pause before you book a trip or help a grandchild. You may have a decent nest egg and still feel unsure. You may have less saved than your neighbor and still be more secure. That happens all the time. Let me just say, if this content resonates with you, the subscribe button is right there. I never waste my viewers' time. Let me show you what I mean with 2 people. Robert is 67. He spent most of his career as a public school custodian. He lives in a paid-off brick house in Ohio. His savings are modest, about $186,000 between an IRA and a bank account. He also has Social Security, and he has a small pension that lands every month like clockwork. Nothing flashy, nothing that impresses people at dinner. James is 65. He worked as a regional sales manager and did very well for years. He lives in a nice condo outside Phoenix. His accounts add up to about $912,000. On paper, James looks like the winner by a mile, but James still has a mortgage, carries more monthly costs, and worries constantly about the market. He checks his balances too often. He sleeps lightly. Robert sleeps just fine. You're already seeing the point. One man looks behind but feels stable. The other looks successful but feels exposed. That's why the question isn't who has more saved. It's who has more certainty. Retirement isn't about how much you've accumulated. It's about whether your income can support your life. And if tax rules change, the person with the better floor usually handles the change better. Here is rule change number 1, and it is a bigger deal than people think. In the 2026 filing season, older taxpayers can qualify for an extra senior deduction of $6,000 per person. If you are married filing jointly and both spouses qualify, that can mean $12,000 on top of other deductions. That is real money, quiet money, the kind that never gets celebrated but absolutely changes the outcome. Here's the thing. Many retirees hear the words deduction and their eyes glaze over. So let me make this simple. A deduction lowers the amount of income the IRS taxes. It does not mean free money dropped from the sky, but it can mean less of your Social Security becomes taxable. It can mean less pressure on withdrawals from your IRA. It can mean more room to breathe, and breathing room matters in retirement. Imagine walking onto a car lot. Every vehicle has a sticker price. Bold, official, intimidating. It looks final, non-negotiable. But nobody pays the sticker. That's how taxable income works for a lot of retirees. The number you think is being taxed is not always the number that actually gets taxed after deductions, exemptions, and thresholds do their work. The new senior deduction quietly changes the sticker. There is a catch, and this is where people get tripped up. The extra senior deduction phases out above certain income levels. If your modified adjusted gross income gets too high, the value starts slipping away. So this is not something you assume. It is something you plan around. Timing matters. Withdrawal order matters. The year you sell something matters. Even part-time work income can change the picture. Let me ask you something. Do you know what your monthly income will actually look like when you retire? Be honest with yourself. Now tie that back to Social Security timing. A lot of people get stuck on one question. Should I claim at 62, 67, or 70? But the real question isn't what's the best age in theory. It's what's the best decision for your life right now. If delaying helps lower pressure on portfolio withdrawals later, that can be powerful. If claiming early protects your cash flow because work stopped sooner than expected, that can also be valid. And this is where people get confused by internet math. Someone says, just delay to 70 because the check is bigger. Another person says, claim at 62 because who knows how long you'll live. Both statements can be partly true, but neither one is the full answer. You have to look at taxes, spousal benefits, health, income needs, and how much risk your portfolio is carrying in the years right around retirement. That is why the new senior deduction matters more than it first appears. If you and your spouse can reduce taxable income in the right years, you may create more flexibility around claiming decisions. You may not need to yank as much from savings while you wait, or you may realize that claiming sooner works because the tax picture is lighter than you thought. Numbers matter, but how you feel about those numbers matters just as much. Rule change number 2 is the larger standard deduction and the updated tax brackets for 2026. For married couples filing jointly, the standard deduction rises to $32,200. For single filers, it rises to $16,100. That may sound like a dry technical detail. It is not. It quietly changes how much of your income is exposed before taxes even start to bite. And for retirees, that changes planning. Think of inflation like an ice cube in the sun. It doesn't melt all at once. It creeps, it nudges. It slowly raises the cost of everything around you. Your groceries, your insurance, your health care, your utilities. Tax bracket adjustments are one of the few ways the system tries to keep that melting from hurting quite as fast. Not perfectly, but it helps. And if you ignore it, you miss real planning opportunities. Many retirees underestimate expenses because they remember what things used to cost, not what they quietly cost now. That is especially true with healthcare, home repairs, and helping adult children. You might think your budget is $4,500 a month, but when you add property taxes, dental work, car maintenance, gifts, travel, and that one surprise every quarter, the real number may be closer to $5,700. That gap matters more than people admit. So when the standard deduction goes up, that is not just a line on a government chart. It can mean a little less tax on the income you are already counting on. It can mean your IRA withdrawal stretches a bit further. It can mean a Roth conversion lands differently than expected. Quietly, silently. Not enough to solve everything, but enough to improve your margin if you pay attention. This is also where the million-dollar myth starts to crack. You hear that you need 1 million, maybe 2 million, maybe more, or else retirement is doomed. But real retirees do not live inside headlines. They live inside monthly math. A couple with a paid-off house, 2 Social Security checks, a small pension, and controlled expenses can be in better shape than someone with a giant account and no income structure. Real data beats perceived data every time. Here's something to think about. If you found out today that you're actually on track, how would that change your week? Let me go back to Robert and James. Robert's monthly life is simple, his housing costs are low, his pension covers part of his basics, his Social Security covers more. His IRA is there to fill gaps, not to carry the whole house on its back. When the IRS adjusts deductions and tax brackets, Robert benefits because his planning is built around income stability. He is not forced to make dramatic moves. James has more money, but he also has more dependence on that money. A big part of his spending comes from withdrawals. So when markets wobble, he feels it. When taxes rise a little, he feels it. When inflation nudges his insurance and association fees higher, he feels it. Sequence of returns risk hits people like James harder. That is the danger of taking withdrawals early in retirement during bad market years. Let me explain that with an image. Picture 2 ladders leaning against the same wall. On one ladder, the bottom steps are solid. On the other ladder, the bottom steps are cracked. If you lose strength at the bottom, the whole climb feels shaky, even if the top looks impressive. That's sequence risk. Bad returns early, while you are withdrawing, can quietly erode a portfolio faster than people expect. This is why guaranteed income matters so much. Social Security is not just a government check. It is a stream of income that comes in whether the market is cheerful or miserable. If you have a pension too, that matters even more. You may already have what people with millions are searching for. Not glamour, not bragging rights, certainty. And certainty is worth more than people give it credit for. Now we come to rule change number 3, and this one matters for people who are still working in their early retirement years or who are trying to make a late push. The IRS increased 2026 contribution limits for retirement accounts. The 401k limit is now $24,500. IRA contributions moved to $7,500. And catch-up rules got better too, especially for older workers. That is not small. If you are 50 or older, you can usually add more through catch-up contributions. And if you are in that 60 to 63 window, the extra catch-up room is even larger. That creates a quiet opportunity for people who feel late. Maybe you scaled back work but still earn income. Maybe you returned to work after caring for a spouse or parent. Maybe you simply realized retirement came faster than expected. You still have tools. Think of your benefit like a faucet. Behind that faucet is a pipe, one you've been filling your entire working life. Every paycheck, every tax contribution, it all builds pressure in that pipe. Retirement accounts work in a similar way. The more you can direct into the pipe in those final working years, the more options you may create later. Not magic, just pressure built over time. And if you wait too long to turn it on, some of that water never reaches you. It just stays in the pipe, unused, gone. No refunds, no second chances. That is why contribution limits matter. The extra room is not there forever. Once a year passes, that year's opportunity is gone. If you are working at 61 and the IRS gives you more space to shelter and grow money, that space is valuable. Now listen carefully. I am not saying every retiree should race back to work and max everything out. The real question isn't how do you build the biggest account possible. It's how do you use the years you still have to strengthen the weakest part of your plan. For some people, that means saving more. For others, it means delaying Social Security. For others, it means paying down fixed expenses. This is also where pensions get badly misunderstood. Many people look at a pension and shrug because it is not a six-figure lump sum they can stare at online. But a pension is income, reliable income, monthly income. If you had to buy that same income stream privately, it could require a very large amount of capital. In other words, some retirees are wealthier than they look because their wealth is hiding inside guaranteed checks. Here's a question for the married folks. Have you and your spouse ever actually talked about what happens if one of you is gone? That brings us straight into survivor planning, because this is where a lot of households make a costly mistake. They plan retirement as if both people stay alive forever and both checks stay intact forever. But often, when one spouse dies, one Social Security check goes away. Household income drops, but many expenses do not drop nearly as much. Taxes can also change because filing status changes. So if you are deciding between claiming strategies, or whether to work longer, or whether to shift more money into Roth accounts, you need to think beyond your own lifetime. The bigger Social Security check in a marriage can matter a lot, because the survivor keeps the larger of the two benefits. That means a claiming decision today may shape one person's financial stability for decades after the other spouse is gone. This is why I keep saying retirement planning is not just arithmetic. It is life design. It is grief planning. It is household resilience. A tax rule that saves a little money now may create more flexibility later. A larger deduction today may help you do a partial Roth conversion without pushing as much income into a painful zone. A slightly better contribution limit today may reduce pressure on a surviving spouse later. Rule change number 4 is quieter than the others, but for part-time workers, semi-retired couples, and disciplined savers, it matters. The IRS lifted income ranges again for deductible IRA contributions, Roth IRA eligibility, and the Savers Credit. That means some people who thought they were boxed out may now qualify for more than they expected. The door quietly opened a little wider in 2026. Here is why that matters. Many people retire in phases now. They do not go from full speed to full stop in one clean motion. They consult. They substitute teach. They do seasonal work. They help a family business. They have wage income, then no wage income, then some again. Those in-between years can be surprisingly valuable if you understand which tax doors are still open and which ones are quietly closing. For example, if you have earned income, an IRA contribution may still be possible. If your income falls inside the updated ranges, you may get a deduction or qualify to contribute to a Roth. If your income is modest enough, the Savers Credit may help too. Again, not glamorous. But these quiet moves can improve after-tax retirement income over time. And after-tax income is what you actually spend. Let me ask you, have you ever compared your retirement plan to someone else's and felt behind? That feeling isn't always accurate. Because most people compare account balances, not income quality. They compare gross worth, not tax efficiency. They compare bragging numbers, not spendable dollars. A couple with $250,000 in smart tax planning can sometimes live with less stress than a couple with $800,000 and sloppy withdrawals. It happens more often than you think. Stop measuring yourself against everyone else. Start focusing on what truly gives you freedom. Now let's layer in another issue that quietly hits retirees: required minimum distributions. Once you reach the age when the IRS requires withdrawals from traditional retirement accounts, that money begins showing up on your tax return, whether you wanted to touch it or not. The current starting age is 73 for many retirees. And if you delay the first one too long, you can end up stacking two taxable withdrawals into 1 year. Think of retirement in two parts, not one big number, two distinct piles. Pile 1, income that shows up no matter what. Pile 2, your savings. Required minimum distributions force some of Pile 2 to start flowing on the IRS schedule, not yours. That matters because it can change Medicare premiums, taxability of Social Security, and your overall tax picture, quietly, all from timing. A lot of people hear age 73 and assume they can forget about it until then. Bad idea. If your traditional IRA is growing and you ignore future RMDs, you may be setting up a much bigger tax problem later. Some people benefit from doing partial Roth conversions before RMD age. Some benefit from smaller withdrawals in lower income years. The right move depends on your numbers, but the wrong move is drifting. And yes, there is still a penalty issue here. Miss an RMD or take too little, and the IRS can impose an excise tax on the amount that should have come out. Even though the penalty rules became more forgiving than they once were, it is still an expensive mistake. That's what makes this so frustrating. People spend decades saving responsibly, then get tripped by a deadline they barely understood. Here's something most people never consider. Do you know the difference between what you need and what you want in retirement? That question matters because many retirees build plans around wants and then panic when the plan looks short. Or they build plans around bare survival and miss the life they actually hoped to live. The goal isn't just to survive retirement. The goal is to enjoy it. But enjoyment feels much easier when your needs are covered by income that does not depend on daily market mood swings. That is why Social Security timing deserves respect. Claiming at 62 gives you income sooner, but usually a smaller monthly benefit. Waiting until full retirement age, often around 67, gives you more. Waiting until 70 can make it larger still. There is no one best age for everyone. The question isn't what's the best age, it's what's the best decision for your life right now. If you are single with health concerns and no pension, you may lean one way. If you are the higher earner in a marriage and your spouse may outlive you by many years, delaying may create stronger survivor protection. If you are burning through savings while waiting, that cost has to be counted too. This is not a morality test. It is a trade-off test. Calmly, clearly, without ego. And remember, Social Security has cost of living adjustments, what people call COLAs. Those increases are not perfect, and they do not erase all inflation pain, but they matter. A check that adjusts over time is different from a pile of money that depends entirely on withdrawals. That is one reason guaranteed income can feel so grounding. It bends with time, even if not as fast as your grocery bill wishes it would. The same thinking applies to pensions. If you have one, do not dismiss it just because it feels ordinary. Price out what it would cost to buy that monthly income with a lump sum. You may be shocked. Suddenly, that modest pension looks less modest. Suddenly, your retirement looks less fragile. Real data versus perceived data again. One is how it feels when you compare yourself online. The other is what your life actually runs on. I want to know, have you ever felt like you were doing everything right but still felt behind? You are not alone. That feeling often comes from looking at retirement through the wrong lens. The real question isn't how do I reach some magic number before everyone else? It's how do I create a life where my recurring income covers enough of my recurring costs that I can stop living in low-grade fear. You're not behind. In fact, you may already be standing on one of the strongest financial foundations available today. Let me make this very practical. If the IRS gives you a larger standard deduction, that may change how much Roth conversion room you have. If the extra senior deduction applies to you, that may lower how much of your other income gets taxed. If contribution limits rise and you still have earnings, that may be a late-stage opportunity. If IRA and Roth income bands move, you may qualify for strategies that were closed before. And please hear this part. Expense underestimation is one of the most common retirement mistakes. People budget the obvious bills and forget the irregular ones. Dental implants, a new roof, travel for family emergencies, replacing a car, helping a child through a rough stretch. Insurance increases. Those are not exotic events. They are normal life. If your plan cannot absorb normal life, the plan is not finished. Think about financial stress like carrying a backpack all day. You get used to it, but it never really goes away. You compensate without even noticing. You say no to things. You postpone joy. You hesitate before spending on health, rest, or time with family. That is what weak income planning does. It creates an invisible weight that sits on your shoulders long after you retire. Now, if you are wondering what to do with all of this, start with clarity. First, Figure out your real monthly spending, not your hopeful spending. Use 12 months of actual bank and card data if you can. Include irregular costs. Second, map your guaranteed income sources: Social Security, pension, annuity if you have one. Third, estimate where the gaps are likely to be and in which years those gaps may widen. Fourth, look at taxes before you make withdrawal decisions, not after, before. Ask what happens if you take more from the IRA this year. Ask what happens if you delay Social Security. Ask whether the new senior deduction applies. Ask whether Roth contributions or conversions make sense in light of your bracket. The people who save the most tax are rarely the ones making random December decisions. Fifth, if you are married, run the survivor version of your plan, not the happy version where both of you are alive and everything stays constant. The survivor version. What income remains? Which expenses remain? Does the larger Social Security check survive? Does a pension reduce? Does the tax filing status change? If you have never run that version, you do not yet fully know your plan. Let me ask you something. Have you ever thought about what your ideal retirement day actually looks like? Not the numbers, just the feeling. Because once you know the feeling, the numbers become easier to judge. Maybe your ideal day is quiet, coffee at home, a walk, picking up the grandkids once a week, lunch with your spouse. Maybe it includes travel or volunteering or a workshop in the garage. The point is this: most people do not need every possible dollar. They need enough dependable income to support the life they actually want. That is where Robert has an advantage over James. Robert built a life that matches his income floor. James built a lifestyle that asks his portfolio to keep proving itself. One man lives with alignment, the other lives with pressure. That does not mean James is doomed. It means his planning challenge is different. He may need better tax timing, tighter expense control, or a new claiming strategy to feel what Robert already feels. And that is the quiet truth under all 4 IRS changes. Tax rules do not just change forms, they change options. The extra senior deduction can create room. The larger standard deduction and shifted brackets can reduce friction. Higher contribution limits can help late savers or semi-retired workers. Expanded IRA and Roth thresholds can reopen doors. None of these are magic, but together they increase flexibility. Flexibility is underrated in retirement. It lets you make a decision from strength instead of panic. It lets you choose whether to work, not beg for work. It lets you help family without silently punishing your future. It lets you delay a benefit if it truly helps, or claim it early if that serves your life better. You don't need perfection to have a successful retirement. You need clarity. So do not leave this video thinking the IRS just gave everyone some giant gift. That is not what happened. What happened is more subtle. The rules moved, the lines shifted, a few doors opened wider, a few traps became easier to avoid if you know where they are. But if you do not look, the benefit of those changes can quietly pass right by you and never touch your life. Think about this. There are people with millions of dollars who don't feel secure, and there are people with modest savings who sleep soundly every night. The difference isn't the number. The difference is understanding. Understanding your income, understanding your expenses, understanding what actually matters. That's the difference between stress and peace. If this gave you a new perspective, if it made you think differently, even just a little, then subscribe. The more clarity you build now, the stronger your future becomes.